on the farm economy, tightening credit conditions will come to order. Mr. Conaway, do you have anything before my opening statement? Or?
Well, no, just to welcome our witnesses, and I look forward to hearing from them, and look forward to hearing yours and David, the Scott Brothers show this morning.
Thank you, Mr. Chairman. Good morning and welcome to today's hearing. This is the second in a series of hearings that each subcommittee is holding on the state of the farm economy. As we know, the agricultural economy is highly cyclical. Given the recent 56% drop in net farm income and the hard times that have inevitably come along with that, I believe it is important to hold hearings like the one today to make sure the credit needs of producers are being met and will continue to be met, particularly if current market conditions continue into the future. While providing credit to America's farmers and ranchers is vital, it is a growing challenge for many lenders in the United States. Perhaps no one knows this better than lenders in cotton country. After a recent period of historic highs, crop prices have plummeted due to various factors which were discussed at last week's hearing before the General Farm Commodities and Risk Management Subcommittee. While input costs have softened, they remain near historic highs, and some of our biggest foreign competitors are sharply increasing their subsidies, tariffs, and non-tariff trade barriers. Unfortunately, the burdensome government regulations have added to the challenges faced by America's farmers and ranchers, with the EPA continuing to push for new and costly regulations. Meanwhile, farmland values are on a downward trend, and while some livestock producers are rebounding on the balance sheet with lower feed costs, our Western producers are struggling with consecutive years of drought. It is times like these that our farmers and ranchers are most in need of reliable sources of credit at competitive rates. Thankfully, we have a network of commercial and community banks, USDA loan programs, and the farm credit system that each play a crucial role in providing that access. In order to sustain an abundant supply of food and fiber well into the future, we must ensure that a responsible farm safety net and sound agricultural credit policies are in place now. To that end, I am pleased to welcome a distinguished group of witnesses and look forward to learning more from them about their perspective and current credit conditions on their outlook for credit conditions in rural America. With that, I'd like to recognize the ranking member, Mr. David Scott, also from Georgia, for any opening statement that he may have.
Thank you, Chairman Scott, and thank you to this distinguished panel for coming to speak with us about the very important subject and I think a very critical issue right now of the tightening credit conditions. Because without access to credit, farmers cannot put a crop in the ground, and they cannot do the important work of feeding the world. I'm especially worried about beginning farmers who are the future of production agriculture in this country and in the world. If we cannot provide the path to capital for these new farmers, we will continue to have an aging population of farmers. This is an issue that I am and this committee are very much concerned about, beginning farmers. And I want to give a shout out and some credit to Farm Credit, who is working closely with me in coming up with ways and means that we can address the issue of beginning farmers. Because according to the National Agricultural Census, the average age of the principal operator of a farm is 58.3 years old. That's nearly 60 years old, ladies and gentlemen. In 1982, that age was 50.5. So within a span of just 30 years, the average age of the farmer has gone up nearly 10 years. This trend will continue if we don't have new farmers who are taking over family farms and then also getting new faces, young people in this country, starting out their own agriculture careers. I want to add a little word here about our cotton farmers, a very critical issue. And what the cotton farmers are going through now is just exemplary of what so many other farmers are going, whether it's peanuts, whether it's tobacco, whether it's watermelons, whatever. Right now, cotton farmers in my state of Georgia and around the country are in a situation where the price of cotton doesn't cover the variable cost of production. The price of cotton doesn't cover the cost, the variable cost of production, much less the total cost, including any land rents that must be paid. This is why I say the issue is critical. The Department of Agriculture predicts that prices could stay low for the next 3 to 5 years. That's why this is a crisis. It's a long-term issue. We got to have a long-term strategy to deal with it. And with total farm debt forecast to hit $372.5 billion in this year alone, I wonder if some farmers will have problems accessing credit in 2017 and 2018. So we got a lot of issues here. I look forward to hearing from the panel's comments. And thank you, Mr. Chairman.
Thank you, Mr. Scott. The gentleman from Arkansas, Mr. Crawford, is not a member of the subcommittee, but has joined us today. Pursuant to Committee Rule 11E, I have consulted with the ranking member, and we're pleased to welcome him to join the questioning of the witnesses. I'd like to welcome our witnesses to the table. Mr. Timothy Busby, President and Chief Executive Officer, Federal Agricultural Mortgage Corporation, Washington, D.C. Dr. Alan Featherstone, Professor and Head of the Department of Agricultural Economics, Kansas State University, Manhattan, Kansas. Mr. Randy Nelson, President, CHS Capital, LLC, Inver Grove Heights, Minnesota. Mr. Busby, please begin when you're ready.
Thank you, Chairman Scott, Ranking Member Scott, and distinguished members of the subcommittee. Thank you for your invitation to appear today to testify on behalf of the Federal Agricultural Mortgage Corporation, commonly known as Farmer Mac. My name is Tim Busby, and I'm the President and CEO of Farmer Mac. I'm here to give you a perspective on what Farmer Mac is seeing in the field related to credit conditions and the overall health of the agricultural financial community. As the secondary market created to serve rural America, Farmer Mac works with over 900 institutions of all kinds in all 50 states through its programs, alliances, and partnerships. By working with such a vast network of lenders throughout the country, Farmer Mac not only introduces more competition into the marketplace to help your constituents receive the lowest interest rates and most favorable terms possible for their financing needs, but we are also able to give you a unique perspective on credit conditions across America. Allow me to sum up briefly what is in my written testimony with a few observations on what Farmer Mac has seen most recently. Working capital levels are currently being tested. It appears farm debt is slowly climbing from historical lows. The Farm Credit System reported nearly a 7% increase in loans outstanding for agricultural production, intermediate term, and real estate lending in 2015 compared to 2014. Commercial banks and saving institutions reported a similar percentage increase in loans outstanding for agricultural production and real estate lending. Farmer Mac's purchases of USDA guaranteed loans increased 8% from 2014. This rising lending activity highlights the growing demand for agricultural credit, but also demonstrates the willingness and ability of ag lenders to meet that demand. Although market data indicates good credit availability in early 2016, we urge market participants to exercise caution and patience as the current industry cycle plays out. Specifically, we believe lenders should apply disciplined lending practices and at the same time be supportive but firm with their customers' requests. Regulators should be aware of the scope and potential credit problems, but also should be cognizant that agriculture is a long-term endeavor and that sometimes the best cure for a troubled credit is not always liquidation. Producers should be aware that major increases in agricultural commodity prices do not appear to be imminent, and that cost containment could provide a new path to renewed profitability. Congress should continue to support the tools available to farmers and ranchers to help offset lower incomes and provide access to credit. One of those tools is Farmer Mac, and we stand ready and able to continue our mission of providing capital to rural America. I understand that there is some concern about land values, so let me touch briefly on this important matter. Of the nearly $3 trillion in farm assets in 2014, over 80% was in the value of agricultural land and buildings. Between 2004 and 2014, the USDA estimate of the total value of farm real estate increased by more than $1 trillion, a doubling of asset values in just 10 years. The rising tide did not affect all regions equally. Much of the increases were centered in the Midwestern United States and major grain-producing states. Let me give you a couple of observations on this. Revenue generated by agricultural real estate has fallen sharply, and it is natural for an asset with declining future cash flow potential to also decline in value. Farming expenses have not fallen at the same rate as farm revenues, which puts additional pressure on the ultimate profitability of farmland. The U.S. dollar strengthened tremendously in 2015, lowering commodity prices and making agricultural exports less attractive in foreign markets. Interest rates have not changed significantly since 2010 and remain near historic lows. A lower interest rate environment supports asset values by reducing the discount rate of future cash flows, and it makes the returns on farm assets more attractive relative to other investment opportunities. As we look forward, there is great competition in the agricultural lending space, and this is particularly helpful for borrowers. More and more borrowers are prudently choosing to finance farm purchases and refinancing with long-term fixed-rate mortgages to lock in low and known interest costs. At Farmer Mac, we work with lenders of all sizes, from those who sell us loans as small as $50,000 to multi-million-dollar purchases. We have unique solutions for lenders who work with small family farms and those that require sophisticated lending facilities. Farmer Mac continues to provide a stable source of liquidity, capital, and risk management tools to help rural lenders meet the financing needs of their customers. With a diverse array of lending products and capital sources, Farmer Mac is well positioned to provide lenders across America with the sophisticated and low-cost lending products demanded by today's rural borrowers. Thank you, and I would be happy to answer any questions you may have.
Dr. Featherstone.
Mr. Chairman Scott, Ranking Member Scott, and members of the Commodity Exchanges, Energy, and Credit Subcommittee of the House Committee on Agriculture, I want to thank you for inviting me to testify. My name is Alan Featherstone, professor and head of the Department of Agricultural Economics, Kansas State University. With a 56% decrease in U.S. net farm income reported by USDA occurring over a 3-year period, concern has begun to arise regarding the future direction of cash rents and land values, along with the overall credit situation. With a decline of 56%, some regions of the U.S. have experienced smaller declines, some larger declines. Kansas State University works with roughly 2,000 farmers statewide through the Kansas Farm Management Associations. These producers provide balance sheet and income statement information that allows the understanding of the distribution of financial performance and provides an overall financial picture of Kansas farms. The North Central region in Kansas is the first association where we have completed information for 2015. They experienced a dramatic change in the profitability of production agriculture. Beginning in 2007, net farm income in Central Kansas increased from between $85,000 to $150,000 per farm per year, 8 years of excellent profitability. In 2015, average net farm income in this region dropped precipitously from an average per farm of $102,500 in 2014 to an average of $11,500, an 89% reduction. This was the lowest level of net farm income for that region since 1985. Based on preliminary analysis with the other 5 Kansas Farm Management Associations within the state, declines in incomes of this magnitude will be common across all of Kansas. Kansas State University, in conjunction with the University of Georgia, conducts a semi-annual nationwide survey of lenders to understand agricultural credit conditions. The most recent survey was conducted in March 2016 and uses similar methodology to the University of Michigan Consumer Sentiment Survey. The survey obtains agriculture lender sentiment on a number of factors for the last 3 months, the next year, and the longer term. Several important changes have occurred in the agricultural economy since the fall 2015 survey. Non-performing loans have increased during the past 3 months. Agricultural lenders expect that non-performing loans will increase during the next year. According to the survey, non-performing loans are expected to increase for corn and soybean farms and wheat farms. For the livestock sector, agricultural lenders expect more non-performing loans for beef farms and dairy farms. During the spring 2016 survey, that same survey, 48% of agricultural lenders indicated that land values decreased, 45% indicated they remained the same, and 6 indicated they increased during the previous 3 months. The expectation of land value changes in the next year became markedly more negative in the fall of 2015 to the spring of 2016. In conclusion, the declining net farm income in 2015 has made for an uncertain agricultural lending environment. The agricultural protection sector and lending sectors are intertwined, causing many lenders to be asking the same questions as agricultural producers regarding the future as they make decisions regarding loan restructuring and other lending decisions. If the sector is entering a major readjustment phase, several factors should be considered. The averages will not drive the bus, but the lower tail of the distribution can. Therefore, more attention needs to be paid to the distribution of financial performance and less on the averages. Given the thinness of agricultural land markets, small increases in land parcels on the market can have major effects on the price of land. The debt-to-asset ratio was more of a lagging indicator of financial stress during the 1980 boom-to-bust cycle, where the debt-to-EBITDA ratio was more of a leading indicator. Farmers and agricultural lenders are entering a current downturn in a strong financial position because of several years of excellent profitability. 2016 will be a pivotal year in production agriculture. Given that average net farm income in some regions were the lowest they have been since 1985, a repeat of that in 2016 will cause some agricultural producers and lenders to make difficult decisions before entering the spring of 2017. Thank you.
Mr. Nelson.
Chairman Scott, Ranking Member Scott, and members of the committee, thank you for inviting me to testify today. My name is Randy Nelson, President of CHS Capital, and I appreciate this opportunity to share with you what we're seeing in credit demand among our farmer and cooperative owners. CHS Capital is a wholly owned subsidiary of CHS, the largest nationwide farmer-owned cooperative. Headquartered near St. Paul, Minnesota, CHS is a highly diversified Fortune 100 company that supplies crop nutrients, grain marketing services, food and food ingredients, and energy products. We also provide a range of business solutions, including insurance and hedging, as well as financial services through CHS Capital. CHS Capital provides operating and term loans directly to cooperatives and individual producers who farm anywhere from 100 acres to over 100,000 acres. In our view, the decrease in crop prices has had a major impact on the financial strength of farmers. Low prices combined with high rent costs have caused nearly all farm projections for 2016 to reflect a shortfall in their ability to meet their current obligations. We have seen some common trends among many of our producers. While some have had their 2014 crop contracted at profitable prices, few farmers had their 2015 crop contracted, and we have seen limited corn and soybeans contracted for 2016. We have seen many farmers who were unable to cash flow their operation in 2015 despite record yields across parts of the Dakotas and Wisconsin and most of Minnesota. However, thanks to several good years in farming, many farmers have built up significant equity in their real estate. This provides them with the option to refinance their land and inject working capital. While this fixes the working capital issue, prices still need to rise in order to service the added debt. It is this farm real estate equity that will allow many to farm again this year. However, the current outlook at the end of 2016, some will reduce their equity to a level that is not sufficient to continue farming. CHS Capital has received requests to finance a number of customers whose primary lender does not want to continue to finance the farming operation. CHS Capital is able to help some of these customers, but we are also taking a closer look at projections and how their equity can support future losses. CHS Capital completed term loans totaling $55.5 million in the first 3 months of 2015, compared with $226.5 million in loans that have been completed so far in 2016. Nearly all of the term loans were written to refinance existing real estate versus new real estate purchases. We expect the number of term loans to continue to increase if commodity prices remain low. CHS Capital has seen a significant increase in past due loans and requests to extend the prior year's operating loan. The low commodity prices have resulted in more customers holding on to their inventory in hopes of higher prices, and an increasing number have had to liquidate assets in order to repay their loan. We've also seen a higher number of customers who have not been able to obtain the operating funding for the upcoming year. With the current stockpiles of grain and the number of acres projected to be planted, the outlook through 2016 and into 2017 is for crop prices to remain depressed. CHS Capital estimates the break-even cash price for mini growers to be in the range of $3.90 to $4.25 per bushel for corn. If prices remain low throughout 2016 and the outlook is not positive, CHS Capital believes that many farmers will choose to preserve their equity and rent out their farmland or liquidate assets. We believe that this will be especially true for farmers who are at or near retirement with no family succession plan. We feel that if significant acres of farmland are put on the market and farmers are willing to walk away from expensive rented ground, rental prices will decline and real estate values will devalue. We also believe some young farmers will leave or work off the farm. And we believe that continued low prices will cause banks to pull away from financing agriculture. Thank you again for the opportunity to share our views on the state of credit in farm country. I look forward to answering your questions.
Thank you, gentlemen. The chair would like to remind members that they will be recognized for questioning in order of seniority from members who were here at the start of the hearing. After that, members will be recognized in order of arrival. I appreciate your understanding. Gentlemen, the most recent farm crisis occurred in the 1980s, and many of those families in that crisis never recovered. What are the similarities of the situation in the 80s and today, and what are the differences that you see in what happened in the 1980s and today? Mr. Busby, we'll start with you and just kind of go down.
I think one of the major differences between the 1980s and now is interest rates. The level of interest rates has been at current levels for roughly 5 or 6 years. I think a dramatic increase in interest rates would cause the situation to be much more similar to that of the 1980s. I think a lot was learned in the 80s. Lenders in particular take a very historical view when they look at the opportunities to finance farmers. I think that's very important. I think it's definitely very instrumental to see lenders who were around and lending in the 80s. There are many farmers and young lenders who were not around then, and we do see them learning and from the history and from their colleagues who were around then. I think it's important not only this year as agriculture has come under stress, but as we progress into the next 2 years, I think that will be very challenging, in particular if commodity prices stay where they are.
I would concur with Mr. Busby. Probably one of the other differences that I would see is the opportunity to use fixed-rate products. A number of producers have used fixed-rate products to lock in interest rates on land loans, and so roughly 50% of their debt is under fixed rates. The other 50% is roughly under operating that would be subject to changes in interest rates. In terms of the land value buildup, it's very similar to what we saw in the 1970 to 1980 run-up. When you look at inflation-adjusted terms, we're about 30% higher in places of the Midwest than we were the peaks. Other places around the country did not see a run-up, and so it's very differential. But certainly in the Midwest and the Great Plains region, there was quite a run-up in land values, which is somewhat similar to the 1970-80 period.
As I look back at the 80s, I saw that as really a high debt crisis situation, so farmers had leveraged their balance sheets significantly. Obviously, as mentioned here, the interest rates are much higher than they are today. As we look at where we are today, though, lenders and farmers have been much more cautious about leveraging their balance sheet, giving more opportunity to try and get through the downturn and the cash positions they're seeing today.
Dr. Featherstone, you said something that stands out in your written testimony with regard to the farm economy, that the averages will not drive a bust, but the lower tail of the distribution can. What is being done to track? How can we track what is happening on these farms at the lower tail of the distribution? And is there anything that can be done on these farms to help prevent this from driving a bust?
I think there's a couple issues that are important to realize. The worst time in the 1970s that you were able to lend was kind of that 77 to 80 period. I had the opportunity at the beginning of my career to look at how those loans performed for a nationwide lender. And roughly about 85 to 90% of the loans they made in the worst time did make it through eventually, although it was very stressful. I think the big thing is there's a need to focus on the downside of the distribution and really understand that the agricultural land market is a pretty thin market. In a lot of places, you're looking at 4 to 5% or 2 to 3% of land trading a year. So 4 to 5%, which doesn't seem like a big change, really can affect price. The other thing I think is identifying those farmers and working with them in terms of restructuring their operations, and for some of them it may be working with them to figure out whether or not farming is in their future.
Mr. Scott?
Thank you, Mr. Chairman. This has been a good panel, and I'd like to ask Mr. Busby, Mr. Featherstone, and Mr. Nelson, because each of you touched on this in your testimony. Let's suppose I have 2 graduating seniors, and which is the case. I gave the commencement address at the University of Georgia's School of Agriculture last year. And I also had a group of young students who want to be farmers from Fort Valley State in my office last week. And this issue came up. How are we going to really address this issue of getting the financing? We have young people who want to go into farming, but they're hitting a brick wall on 2 fronts. First of all, the high cost of land, the high cost of equipment. What is being done to give some help there? And then secondly, many of these graduating students have student loan debt. So it's not like if you graduate and you get a degree in finance, you go work for a bank, bam, you get a big salary. But in agriculture, you got to seriously go to work. You got to get land, you got to get equipment, you got to get property. I mean, how are we addressing this for this young person that wants to go into farming and is faced with college debt, with all the other debt? And I'd like to know just what the land price would be for an acre.
Well, certainly for a young beginning farmer, entering into farming is an uphill battle. Without the support of a family structure and perhaps an older farmer within the family who is exiting the business, it's very difficult to get started. Certainly where we see an environment where interest rates are low for the purchase of land, that's helpful, but we also still see land values at relatively close to historic highs. You also see expensive rental rates if a farmer were to enter and begin renting, and the availability of equipment financing as well can be challenging. With all that said, there is a push amongst lenders, particularly in the farm credit system and in the community banking communities, to focus on young, beginning, and small farmers. I think that will continue to be a challenge for many years, and if the farming conditions and the farming economy struggle for the next several years, I think that will persist and be very difficult to enter into farming for beginners, particularly those coming right out from school. The existence of other debts related to education and other things will also only add to that burden. I think many years ago, looking back to the 1980s, as many people saw struggling on the farms, people didn't want to get into agriculture, and they kind of fled to the coast and got away from agriculture and went into different areas maybe related to ag finance, but not in agriculture in particular. Over the past decade or so, as farmers have done very well, I think there's been a push for people who grew up on the farm, went away to college, and then want to come back to the farm. I think that's returned, and it's really just happened in this last year or so where that's not looking as favorable as it has for the last decade.
Well, let me just ask you all, don't you all think it would be helpful? Some of us here in Congress really feel the pinch on this, and I believe it would be helpful if we could develop some financing help here that would take care of loan forgiveness for a certain number of students. It doesn't have to be everybody, but at least we can start that who will go into farming, and to give scholarship aid of those. So when they come out, at least they will not have that hanging over them and going in. But it would be interesting, I think, to know what would you say is the total operating cost of the average farm? Ms. Featherstone?
For the farms that...
And what would be the average size farm?
Yeah, the average size farm there would probably in Kansas be about 800 to 1,000 acres. The average expenses would be about $500,000. One of the things that may be a possibility, and I know the Department of Defense is working with transitioning some of the soldiers into farming operations, where they're trying to match soldiers that have a desire to farm with individuals that may be nearing retirement. And so perhaps something like that might be a possibility to also look for college students.
Thank you, Mr. Chairman.
Mr. Conaway.
Thank you, Chairman. And gentlemen, thank you for being here. Just to try to understand mechanically, make sure we get that in the record, high land prices, the risk of those dropping to the lending side, what's the normal, or what would be a typical ratio of collateral value to loan value in most of these organizations? Mr. Busby?
At Farmer Mackin, what we see generally industry-wide is a maximum loan-to-value ratio of 70%.
All right, so if we had a 30% drop in the value of land, the bank would be about even with its debt at that point in time. So it's got to be greater than that.
Correct.
In order to have a real dramatic impact on lending or on those loans. What, Dr. Featherstone, you mentioned farm income. Does that include any kind of compensation to the farm family itself? Let's say you've got the typical structure, family farmer, and doing it. Is he taking out a salary out of that number? What is that number?
Yeah, the net farm income that I mentioned would not include any other income.
So
that
if
the
it went
family
from
may have.
111,000 to 11,000, that 11,000, farmers make about $1,000 a month to pay for his own medical costs and you know the normal things that a regular family would have to pay for.
Yes, in this situation, if all the income from the farm or family was from the farm.
Well, that 11,000 is just farming income.
It's just the farm income, and
All
so
right,
if there were
off-farm,
if there were off-farm incomes, and that's
Yeah,
going to
that'd
be
be on
pretty
top of that.
important with regards to the rural economy, making sure that that's strong to provide those job opportunities.
Right. The either Mr. Nelson or Mr. Busby, a lot of challenges with respect to lending. Obviously, it's got to be safe and sound. The bank's got to be confident it's getting his money back. Are there regulatory burdens associated with farming that are exacerbating lending decisions as either the regulations to operating a farm or regulations at how you lend to a farmer? Mr. Nelson, you're nodding your head. Yes, let you go first.
Yeah, I'll make a comment that as that pertains to CHS Capital. We're regulated in a different way than banks are, so it allows us a little bit more flexibility to create innovative programs to help out farmers. At the same time, we need to make sound decisions
Right.
around the credit, viewpoint and what it looks like into 2016. But we do have some innovative programs that we have put out here recently to help farmers get.
Well, I guess I'm looking for the regulations that are preventing you from doing that. Mr. Busby, you have comments about specific regulations that farmers are dealing with that don't really help bankers make sound decisions?
Well, there are a wide spectrum of regulations that impact farmers, varying from those that impact the lenders and the financial institutions that serve them, but also environmental and water laws as well. I think while many of those laws may be socially, from a social accountability standpoint, they may be well intended. There can certainly be adverse consequences which can adversely affect farming, the value of land that is available, and then ultimately then lending decisions that we may make.
Dr. Featherstone, you mentioned that a potential leading indicator would be debt to earnings before interest, taxes, depreciation, and amortization, or the ever-popular EBITDA. What's that leading indicator telling you now?
Essentially, that's beginning to move up. I've done some work with Paul
Up good
Ellinger
or up bad?
at the university. It's moved up quite a bit.
I know, which is up good or
Oh,
up
sorry.
bad?
Moving up is bad.
Okay.
In terms of the lower that ratio is, the better off you are. In terms of, for example, in north central Kansas, I haven't calculated those numbers yet, but they will be negative for this coming year, simply because you have to look at principal repayment and family living when you begin looking at that.
Okay, but I thought you said it was earnings before.
Earnings
Interest,
before
taxes,
interest,
depreciation,
taxes,
and
depreciation
amortization.
allowance.
Those don't include expenses.
It won't, I misspoke there. It won't be negative.
Yeah,
but
because that would be really.
Right.
You said
I'm
down was
thinking
good,
I'm
so
thinking
negative
of the
would be great.
capital repayment capacity ratio,
Okay.
which will end up going negative for that reason.
All right, so as a leading indicator.
It's a leading indicator of cash flow and just the ability to repay loans.
So
out
it's
of
indicating
earnings.
to you that things are going to get worse before they get better at this stage?
Unless that changes, yes.
Okay. Thanks, Chairman. You're back.
Mr. Aguilar.
Thank you, Mr. Chairman. Mr. Busby, you talked a little bit about younger farmers in response to the ranking member. In California, beginning farmers tend to be slightly younger than the national average, but the number of beginning farmers has dropped 29% between 2007 and 2012. Again, I mean, what role does the high real estate market play in these declining numbers of young farmers entering the market? What other factors are discouraging young people from managing a farm? And to pick up where the ranking member left off, what can Congress do to foster some of these policies to support young farmers' strengths to combat their weaknesses?
Certainly with respect to land values, the situation in California is very different than from what you see in the Midwest. I think USDA in some ways and the products that they offer can be instrumental in helping young and beginning farmers as well. I think the flexibility that can be offered to farmers that can't, whether beginning or seasoned, that can't access credit in the traditional markets do see vehicles through USDA that can be helpful. I think Congress's oversight of financial institutions, the Farm Credit System, and elsewhere promoting the lending to young, beginning, and small farmers is critical. I think as well as in California in particular, as you see very diverse agriculture there that is very capital intensive, I think that there are specific challenges in that state alone that are much more difficult to address than throughout the Midwest.
Thank you. Dr. Featherstone, you mentioned a program for returning soldiers. Can you elaborate on what that program looks like and where we might be able to take that from a congressional perspective moving forward?
Yeah, essentially, there's a grant program that allows organizations to work with retiring soldiers. And the way that it's working in Kansas is Farm Bureau in conjunction with Kansas State University and Fort Riley, which is located very, very close to the campus, or trying to match up individuals, teach them basic agricultural skills, try to match them up with individuals that could mentor them into the process and maybe at some point transition the operation from a generation that does not have heirs to one that to the individual that has built that human capital.
Great, thanks. I think that's a worthy program that we should discuss. Some of us are on armed services as well, and there could be a connection there. I appreciate that answer. Dr. Featherstone, again, you and for Mr. Nelson, in recent years in the community I'm from, a number of farmers in my district, and I think you've alluded to this in your testimony, are finding that their children don't want to continue the family business. These farmers resort to selling their land to fund their children's college education or to help finance their own future. For many family farmers, it's important to keep the business with a trusted source when selling. What types of tools are available for those who are evaluating, what the outlook of their farm is as they're selling it, and what factors should be taken into consideration so they can find the right time for them to sell if that's the choice that they're making?
Until this year, essentially, at least in Kansas, where I'm from, there was a strong desire for college graduates to go into agriculture. And so as of yet, I'm not sure we've seen the graduates catch up with reality. I'll be doing exit interviews next couple weeks, so I'll have a better picture of that in a couple weeks. But I think the big thing is timing, and I think the big thing is providing some mentorship opportunities for those individuals. But certainly timing is critical in terms of now is probably not a time they're going to find very easy to move into the production agriculture sector.
As it's already been mentioned here today, next generation farmers is going to be very, very difficult to get into agriculture. Just yesterday, I was speaking to a customer of ours from Texas, a cotton farmer in Texas. He farms 36,000 acres. He's been in farming 38 years. And his comment was, I don't know who's going to farm my land when I retire. Because he said, young people will not have the opportunity to come in and purchase land and begin farming in this environment. So, we continually need to look at ways to help young farmers enter into farming. We're looking at programs today, CHS Capital, to help finance and provide operating funding for young farmers, but certainly will be a challenge in the future. I think it's important that farmers also look at succession planning, and they need to start that immediately. I think that industry could do a much better job in planning ahead so that the next generation can come in and continue the operation.
Thank you, gentlemen. Thank you, Mr. Chairman.
Mr. Kelly.
First of all, and this is to Mr. Busby, thank you, Mr. Chairman, and thank you, witnesses and the panel, for being here. I really appreciate it. Mr. Busby, what effect can government regulations such as waters of the U.S., what are they having on our farming right now?
Well, certainly there are regulations, as what you mentioned, that can have adverse impacts on a farmer and his operation, as that also may have a dramatic direct increase on the farm itself and the land, certainly making it very difficult to provide financing to land that's adversely affected by such laws, and also preventing, in some cases, that farmer from being able to liquidate his land and sell. I think that can be quite a challenge.
And just following up, and what specifically does it do to farmland values?
Dramatic reductions.
And either of the other two witnesses are welcome to comment if you would like.
Yeah, I think that was covered well.
And Dr. Featherstone, farmers rely on crop insurance, and you made some important points in your written testimony about how when the price of commodities decreases, farmers with crop insurance take an additional risk because their insurance covers less of their variable costs. What are the implications of this reduction in risk coverage for farmers?
The key implication is farmers are assuming more of the risk than they did just 2 or 3 years ago. Using some numbers that were in the testimony, comparing it to 2013, which admittedly is the high, they're taking on between 30 and 40% more risk simply because that guarantee decreased. There is the opportunity for them to buy up additional higher coverage levels, but certainly with the prices decreasing, there is more risk and less of the revenue is protected on those revenue products.
And Mr. Busby, in your testimony, you indicated that crop insurance and the other components of Farm Safety Net, including ARC and PLC, are extremely important to agricultural leaders. Can you elaborate a little bit on this?
I think as we've seen in recent times, in times of drought and other adverse weather conditions, crop insurance becomes a safety net and certainly allows farmers to continue their operation where they otherwise may not be able to in a particular year. I think for the long-term health and safety and risk management of those farmers, those crop insurance programs are critical.
Any of you other witnesses have any comments?
As a lender, I look at the crop insurance programs and the government payments as a critical component in any kind of credit analysis. So as we look in the future, we'll see, obviously, we've seen crop prices drop. which does impact the level of coverage from the insurance standpoint and will adversely affect potential decisions around credit extension in the future.
And then finally, and this is to anyone on the panel who wants farmland values and the potential bubble in the farm real estate. Would you give some brief examples of if you think that the bottom may fall out, and can you compare in any way to the 08, 09 housing crisis? Do you see that as a potential with farmland values?
We've seen over the past year a slight drop in farmland values, but nothing real significant. I think there's still an optimism in the market around what farming will be in the future and the need for farmland, of course, in that equation. So I don't see the bottom falling out of this. I certainly see a softening of the prices as we go into 17 if the prices stay as they are today.
Mr. Busby, do you have a comment on that?
I would just say that over the years, many farmers for decades have been farming and have done well and have very solid balance sheets. The softening in land prices that we have seen does present opportunities for some of those farmers to purchase additional land. So I think that provides a bit of support that should prevent a similar crisis to what we saw in housing.
I thank the witnesses again, and Mr. Chairman, I yield back.
Thank you. I now recognize the gentlelady from Arizona, Ms. Kirkpatrick.
Thank you, Mr. Chairman, Mr. Ranking Member. I want to follow up on my colleagues' comments about the Veterans for Farming. You know, I visited Mr. Featherstone, one of those programs in Arizona where the veterans come, they live on the farm, they learn to grow a certain crop, and then presumably go out and farm. But in talking with them, I mean, they're not from wealthy families. They come back from the wars with no assets, no home. Some of them don't even own a car. And so my question is not just for you, Mr. Featherstone, but the entire panel. Are you aware of any programs specific for veterans that would lend them money to buy a farm and operating capital when they have no assets? We'll start with you, Mr. Busby, and then we'll just go down the line.
Well, I think that is challenging. I did allude earlier to the USDA and some of the programs that they have for beginning farmers. However, they continue to be under financial pressure and staffing pressure. I've recently visited a number of states where you see the administration of the FSA and other USDA programs throughout the country, and in certain states that functions better than it does in other states. So I think from a service perspective, I think the funding of those USDA programs, the staffing of those programs, and a focus on making them successful is critical.
Mr. Featherstone?
In some respects, I think it's very hard for the asset acquisition. And in some respects, I think that's where the match of who the mentor is in terms of whether or not they can set up some type of sharing type process through that mentorship. But it's probably going to be a long process, which isn't all that unusual for individuals that are in a family farm many years. They work for their parents, who hopefully are their mentors, and at some point take over. And so typically it's been a long process in agriculture to acquire those assets to begin to take the lead and manage them.
Mr. Nelson?
Yeah, obviously a difficult situation when we start looking at lending to the next generation. But I do think there's creative ways to accomplish that. As you look at staging in potentially lending to young farmers or next generation farmers by relying on the equity and support of the family. And so I think there are definitely ways to accomplish that task.
Yeah, I'm really concerned about this, and maybe the committee can look into it more, because in talking to these young people, they definitely have the desire to farm. And evidently, according to your answers, it really would be almost impossible for them to purchase land. But let's assume then that they find something they can lease. Do you approve leasing leases and before you consider lending operating capital? And again, just go down the line. I'm just curious about how that works.
At Farmer Rec, we lend money to owner-operators, those who buy a farm and operate it themselves. We also lend money to farmers that lease their land out. Generally, we have not seen to date challenges with getting land leased. as land values have come down and the profitability for farmers who are leasing land comes under pressure, there will be demand by those operators for the rental lease payments to come down, which adversely affects the landlord who we've lent money to. So there is a balance there that needs to be struck, and as multi-year leases that are 2 or 3 year leases come due, there will be pressure on those landlords to reduce rents to the operators.
Let me just follow up. Would it be possible, say for a first-time veteran farmer then, to get operating capital on a lease through your company?
Not through Farmer Mac, no. We lend just on real estate.
Mr. Featherstone?
I work for a university, so
Oh,
we
that's
don't
right.
lend.
Yeah, you're not probably, yeah. Mr. Nelson, you're in the private sector.
From CHS Capital standpoint, we do offer coverage for lease payments, so it is an option, certainly in an operating line, to finance those kind of expenses.
So I'm really concerned. It looks like the door, we train them, they have the desire, but then the door closes because they can't get the capital or to buy a farm or to operate. That concerns me, Mr. Chairman and Ranking Member. My time's running out, but I just want to ask if any of you who typically buys farmland that's being up for sale, and do any of you have a concern that we might run into a deficit in this country in terms of having farmland that's actually being farmed? Why don't we start with you, Mr. Nelson, and we'll go down the row the opposite way.
Yeah, surprisingly, we just typically don't see a lot of farmland go on the market, even with the situation we're in today. A lot of times it's neighboring farmers that look to expand their farm that's taking advantage of those opportunities. But I do see long-term, I mean, we've had a lot of farmland come into production during the good times when we had $7 corn, so there's significantly an increased acres being farmed today. So I don't see that as a concern or a shortage going forward to meet the demand.
As my time has run out, does anyone differ with that answer? Okay, thank you. Mr. Chairman, I yield back.
I now recognize the gentleman from Texas, Mr. Nogelbauer, for 5 minutes.
Thank you, Mr. Chairman. Recently I've had conversations with some of the bankers in my district and some of the farmers, and one of the things that we're hearing, and it's unfortunate that some of those farmers are not being able to renew their loans at the bank. And so they're being referred to FSA to see if they can arrange their financing. I guess the question I have is what kind of trend you're seeing in that direction, and also, what long-term are the consequences of, people being forced to move out of traditional financing availability?
The example you give is a very good one, and something that we hear quite often here very recently is that an operating lender is unwilling to renew an operating loan. The farmer's unwilling to pay it back, and what often happens is they then refinance their land, their mortgage on their real estate to include the operating loan, hopefully in those cases lock in a long-term fixed rate where rates are now, but oftentimes because of the qualifications and credit underwriting standards, they're not available to be served in the traditional markets and do turn to USDA, sometimes with hybrid financing through a private lender and USDA, and sometimes just with an FSA loan.
Anybody else want to comment on that?
I'll just comment on what we're seeing in CHS Capital. It's mid-April, well past the day when we should be seeing applications for operating lines. And we're seeing many come in today that have been turned down by other financial institutions. So it's definitely a concern. And there will be farmers there are farmers that are looking for ways to still to finance their operation for 2016.
And the issue that we've been kind of talking about, particularly with the land, and I think something that you mentioned, your customer that farms 36,000 acres in Texas, most likely could be in my district. And that's a very important question, who is going to farm this land in the future? And what we've seen in agriculture, particularly in my part of the world, is consolidation. My wife grew up on a cotton farm in West Texas, and their family farmed a half, quarter section, half section, and that was they made a living doing that. And those days are over. So the farms are bigger, the risks are larger, the capital requirements are larger. And many people that, some people are renting. I don't know, that 36,000 an acre, if he owns all that land, or he's most likely probably owns some and leasing some. But the question is in the future, you know, who is going to have the ability to absorb that? Because we've seen quite a bit of consolidation, and as the gentleman from Georgia pointed out, the 59, 60-year-old farmers, you know, at some point in time, that they finally say, you know, I'm not going to do that anymore.
Yeah, I'd like to continue with my example with the Texas farmer. He had mentioned that he took on 2,000 more acres a couple years ago because the farmer couldn't continue. But at the same time, what he's saying about 2016, he said we're set up for failure. Right now, with average prices and average yields, we will not be able to pay back our operating loan in 2016. So the question becomes, if things continue as they are, what does happen to the extra farmland that comes up for lease or purchase? I mean, there's definitely going to be a reduction in rent values or a reduction in some real estate values to actually make that work out in the future for them.
Yes, some of the farmers, just like the one your example, have told me, you know what, Randy, this year I'm going to turn back some, you know, some acres. He said, I just can't make the numbers work. I think one of the interesting things, I was in the banking business from 75 to 83, and we were in a different, you know, regulatory environment back then, and our bank was a pretty large agricultural lender. And, you know, we carried over, you know, farmers from year to year, and sometimes probably when we shouldn't have, but, you know, we knew those people. Today's environment is such that with the regulatory environment, you know, those days are over if you can't show the cash flow, and if you can't show the equity. Just, you know, from a regulatory perspective, those lenders can't continue to do that. And I think as we see folks move to FSA, at some point in time, if the numbers don't work for the conventional lender, you know, it's going to be difficult for the FSA, I think, to continue with some of those. So I think the crop insurance piece is an important piece of it, and one of the problems we have in West Texas in cotton is that there's really no price protection built into crop insurance. And so it doesn't matter whether you can, you know, make a crop or not. If you make it and you can't make any money doing it, then the crop insurance is not really done you a whole lot of good. With that, Mr. Chairman, I yield back.
I now recognize the gentleman from Arkansas, Mr. Crawford, for 5 minutes.
Thank you, Mr. Chairman. I appreciate you allowing me to sit in today. A lot of talk about crop insurance, and I know that that's important from the standpoint of lenders, analysis, preparing crop loans and things of that nature. But I got to put my parochial lenses on here and talk about my district for just a little bit. My district is home to about half of the U.S. rice crop, and crop insurance is really kind of a tough sell there. We're pretty heavily irrigated, as you would know from rice production. And so they spend that money in investing in irrigation, and rice is an expensive crop to produce. And then another issue that sort of is problematic for rice producers with respect to how they secure or provide a little risk management is that the price discovery is difficult. Rice market's very thinly traded. It makes it expensive to try and hedge for the average farmer. So using those type of risk management tools are difficult. I wonder if, Mr. Nelson, I'll start with you, if you might have some suggestions on where they should go. I mean, the crop insurance products, I mean, the actuary base for rice is somewhere around $3 million. That makes it cost prohibitive to a large degree. But what would you recommend, and as a maybe a new approach?
There's no question that crop insurance adds, critical benefit to both farmers and to lenders, but it doesn't for the widespread crops. It's not covering all crops, as you mentioned on rice. I mean, there's certainly issues, what I'm hearing on from a cotton perspective as well. Mm-hmm. So I think as we look at the new Farm Bill, I think we need to look at how that program can be enhanced to create a greater safety net for our producers. And some of that look has to be not so much price-driven potentially in the future. Obviously, as we see prices drop, the level of coverage in that safety net has declined as well. So I think we need to look at creative ideas beyond just price and expand the coverage so it reaches more crops as well.
Mr. Busby, any thoughts?
I would say research and hearing from producers themselves what protections they're looking for. As lenders, we look through a slightly different lens. We're looking for the ultimate ability for that farmer to be able to pay back their loans. The farmers themselves are looking for ways to fund their operations, finance the capital, finance the capital needs for their operation, but also to sustain, their family sustenance. So I think they may look at it slightly differently. So I would encourage hearing from farmers themselves and producers as opposed to just lenders and others.
Dr. Featherstone, you're an economist, correct?
That is true.
Let's hear your economist perspective.
I think the key thing with crop insurance is to allow producers to have choice and to have different types of products and experiment a little bit. One of the things that some other countries are working with is some weather type insurance contracts where they'll end up basing the payments out based on rainfall or other types of weather type phenomena. And so with the increased technology that we have to measure sunlight, rainfall, those type of things, those might be something to look at down the road.
I'm concerned, in the broad sense that we're looking at crop insurance as sort of the panacea for agriculture, and then if we tweak it enough, we'll be able to come up with something that works. And I think that we may be going down a road where we think we can just insure ourselves into prosperity for, in the ag economy. Mr. Nelson, your thoughts on that?
I agree. We look at crop insurance strictly as that worst case situation as a lender, and it provides us with some assurance that the downside number or risk is going to be X amount using insurance. So it's not going to solve the problems.
My other concern, quite frankly, is, when we talk about, some of the policy, amendments to the Farm Bill that were introduced that, address the AGI and that also address active engagement, that in effect what we're really creating is a dynamic that almost forces consolidation. As an economist, Dr. Featherstone, do you see that?
Certainly, I think there can be those concerns. I think the key thing that we have to get back with insurance is it prevents downside risk or helps manage that. We've kind of got into a situation where it's a profitability or an income enhancement. I didn't collect my life insurance last year, and I'm glad that I did not.
Exactly. Exactly, and that's why I think we need to rethink our approach to that. I appreciate you being here, and I yield back.
I now recognize the former chairman of the committee, Mr. Lucas, for 5 minutes.
Thank you, Mr. Chairman, and I appreciate that, and no one has described me as having a key role in this mess, so the kindness of my colleagues. Dr. Featherstone, I'll turn to you first, and of course your colleagues at the table can comment if they care to. I apologize for being slightly late. I know there's been discussion about how commodity prices have affected land prices, and that's impacting people's ability to sell. But just as important as it is for primarily our older farmers to be able to harvest that lifetime of equity, which is, in many cases, the equity in their most important capital asset, their farms, there's also the issue about producers, both beginning and established and senior, not being able to tap that perceived equity to operate their businesses. Because after all, every banker smiles if your farm's paid for, or mostly paid for, or a high percentage paid for. Let's discuss for a moment about how commodity prices have affected land prices and how that's affecting day-to-day operations on producers who use that as their piggy bank, so to speak.
Yeah, certainly, essentially with the run-up in land values, I think there's a couple important aspects. One is that increases the barrier of people wanting to enter the farming profession. And so from that perspective, there's always two sides to a coin in terms of whether or not you're buying or whether or not you're selling. I think the other thing, and it'll be interesting to see over the next couple of years in terms of just what costs are out there that can be pulled out of the sector. One of the things we've saw in Kansas is essentially a 20 to 25% increase in variable costs. Some of that is normal economics. When prices are high, you're going to spend more to get that last bushel out. When prices are low, I think there's going to be adjustments made, and I think over the next couple years, we're really going to see just what that cost structure is in terms of my brother-in-law's farm, and what they ended up doing is they ended up paying for someone to spray to get it timed more correctly. However, in this environment, they may decide we're going to do it ourselves, or maybe we're not going to go for quite that yield level given the price outlook.
Well put, Professor. I represent, of course, a district that is a huge amount of state border with the great state of Kansas. And I always remind the folks who are not from our region of the country that Mr. Steinbeck's book about the 1930s was not an agricultural economics text. It was a social statement. But that said, in the lifetime of myself, my parents, and my grandparents, we've had a number of great catastrophes in the Southern Plains. The Depression of the 1930s and the Great Drought of the 1950s, the economic meltdown of the early 1980s, and now hopefully it's broken, the drought in my own area from 2011 through 2014. Some of those things we cannot help. Mother Nature's Mother Nature, the weather's the weather. But the other issues, such as the 1980s and the 1930s, where bad federal policy almost destroyed entire generations of farmers, that's something we can do things about. We've talked here today about the challenge in commodity prices. We've discussed the nature of the safety net that insurance is supposed to provide, either through yield issues or price issues, depending on which commodity you group in, and it's not all universal. But isn't it fair to say, Doc, that a little bit of the challenge we face is a combination of things that this committee doesn't control? For instance, the requirements for ethanol, renewable fuels, which perhaps drove the consumption of certain feed grains, perhaps at a steeper pace than should, now looking back, have been appropriate. Then combine that with god-awful weather events, the 2013 failure in the Midwest of the corn crop that led to $7 corn, which then drove the decisions as acres were coming up for renewal in CRP. We're dealing with things here that are not just the Farm Bill. Isn't it a fair statement, Doc? The weather, policy decisions in other committees, international trade issues. The cotton folks are suffering from a WTO deal that perhaps was not in their best interest. But all those factors together have created the situation we're in now.
I would concur, and one of the things that concerns me most is not within the agricultural sector, it's just the value of the dollar and the macroeconomic effect. Simply to give a little bit of indication, if you were in Brazil, based on the value of the real, you could consume as if you were producing about $14, $15 beans, where in the U.S. we're looking at $7, $8 beans. So certainly a lot of what's going on here is outside the agricultural policy realm that this committee focuses on.
Yet there are things that we have to deal with on the committee. You as a policy developer have to try to address, and ultimately our constituents in Oklahoma and Kansas put their very capital and life on the line. If you'd humor me just one more moment, Mr. Chairman. The old adage amongst the country economists, the folks at the feed story, is the answer to price is price. $7 corn drove planning decisions that have now reduced corn by essentially half. But again, the answer to price is price. As you noted earlier on inputs and the overexuberance to spend on investing in the crop, we'll now see that drop. So we will go through a rebalancing at some point. I would just note to the esteemed chairman of this committee, subcommittee, that perhaps we have to take a look at those CRP authorized acres again over the course of the next couple of years. We don't want to waste resources, and soil is our most valuable resource. That said, Mr. Chairman, I yield back and thank you for the hearing today.
Thank you, Mr. Chairman. I have one final question, and I want to go back to the fact that while we've talked a lot about the farmer, it's not just the farmer, it's the whole rural economy. It's it's the person who sells the seed and the fertilizer. It's in cotton country, it's your gens. Your tractor dealers certainly are directly impacted by it. Your local car dealers are impacted by it. Your local banks are impacted by it. Your local restaurants are impacted by it. Certainly, if things are good on the farm, then things are good with regard to the rural economy in this country. And if things are bad on the farm, things are tough for the whole rural economy. Mr. Nelson, one of the things that people outside of agriculture may not fully understand is that if you can't obtain your operating loan, what that actually means to farmers and therefore that rural economy. Can you explain the end result if a farmer is not able to obtain an operating loan?
There's no question of the negative impact to the community. I mean, this is a far-reaching problem that goes beyond just a farmer that's having trouble financing his operation. And we're already seeing the impact. We're seeing the impact with local cooperatives who are struggling or the margins are being compressed. We're seeing it, as you mentioned, with the machinery dealerships who are not selling new equipment. And so this is a far-reaching problem that goes down Main Street in the rural communities. And obviously the operating lines are the key for farmers to get in the field, to finance the crop inputs, finance planting, finance the harvest of the crops. And farmers, obviously, as I mentioned before, having difficulty finding operating lending into 2016, and that will have a far-reaching impact through rural communities.
Most of the cotton pickers that run in Georgia are made in Iowa, and even though you don't grow any corn in Iowa, certainly that means that they're directly tied to the cotton economy. So with that said, I'd yield to Mr. Scott from Georgia for any closing statements or final questions he may have.
Yeah, thank you, Mr. Chairman. This, I think, has been perhaps the most important hearing that we've had this year, because finally we're touching on what is the real crisis facing agriculture and farming. And Mr. Nelson, Dr. Featherstone, Mr. Busby, each of you, I congratulate you on the depth and knowledge that you have of the crisis that our farmers are facing with this terrible collapse of the net income of farming and the rising categories of debt that they have. At what point, and no wonder, as some of the other members of the committee have pointed out, family members have no choice. They can't even go and continue the family farming. The greater tragedy of this is the American people's only familiarity with farming and agriculture is Publix or Kroger's. We go there, and that's about as close as we get to farming. And I think, Chairman Scott, that commend you on pulling this hearing together, because I think we hopefully are hearing what I call a Paul Revere moment. You know, he went around and said, the British are coming, the British are coming. Well, we're saying right here that trouble is coming to our nation if we don't address these critical issues of agriculture and farming in our country, beginning farmers, the cost of it, the inability to keep up with it. And woe to this country if we don't address it and become more and more dependent on foreign nations for our food. Man, if we ever get to that point, we're truly gone. So, Mr. Chairman, thank you. And I just want to say that when our farmers have had trouble before in this country, particularly going through the 1920s and then into the Depression, the Congress and the federal government rose to the occasion and helped our farmers, whether it was for the boll weevil or what the farmer was faced. And this is our challenge at this crisis to rise to the occasion. You know, it's not just the finances. You got that enough on the farmer. But as the gentleman, I think Mr. Kelly pointed out, you got these over-regulations like the Waters Rule coming at them. We've got to address these issues, Mr. Chairman. I thank you for this hearing, and I thank the panel members.
I certainly agree with my colleague from Georgia. Americans have never been dependent on a foreign country to produce our food supply, and I hope that we never are. And I think that one of the charges of the Agricultural Committee is to make sure that we're able to keep good farmers, good families on the farm, out there producing the food supply that we as Americans need and are dependent on. And I just pray that we're never dependent on any foreign source for our food supply in this country. And with that, under the rules of the committee, the record of today's hearing will remain open for 10 calendar days to receive additional materials and supplemental written responses from the witnesses to any questions posed by a member. This hearing of the Subcommittee on Commodity Exchanges, Energy, and Credit is adjourned.